Today we're diving into Legal & General's latest results. And it's more than just a story about numbers. It's really the story of a financial giant with a relatively new CEO at the helm making a very deliberate and very confident change of course. So let's break down what's really going on here. And the very first thing you need to see is this number, 1.2 billion pounds. Yeah, that is the absolutely jaw-dropping size of the share buyback that Legal & General has just kicked off. It's a massive, massive signal of confidence from the top, and honestly, it's the centerpiece of this entire turnaround story. So how can they possibly make such a bold move? Well, it's because all this confidence is being built on a rock-solid foundation. The latest results, they show a company that isn't just stable, but is actually growing pretty impressively under its new strategy. And what's really interesting here is that these key growth metrics, they all beat expectations. Core operating earnings per share are up 9%. That's hitting the high end of their own guidance. Then you have operational surplus generation, which is just a fancy way of measuring the new capital the business is creating. That's up a very healthy 5%. And of course, they've increased the dividend for shareholders. It's just a really clear picture of solid performance right across the board. Okay, and for an insurance company, this is the number that really, really matters, 210%. This is their Solvency II coverage ratio. Now, in simple terms, think of it as a measure of their financial shock absorbers. A higher number means they have a much, much larger capital buffer than they're required to, and that shows immense financial strength to both grow the business and weather any potential storms. And this quote from the CEO, it just perfectly captures the new management's mindset. Antonio Simões is basically saying, look, we made promises and we are delivering on them. This really hits on the core themes of this turnaround: simplification, connection, and, probably most importantly, execution. All right, so where is all this growth actually coming from? Well, to really understand L&G, you've got to look at its three core business engines. Let's see how they work. First up, you've got the powerhouse, institutional retirement. These guys are the market leader in a business called pension risk transfer, or PRT. It's where they basically take over the responsibility of paying a company's pension promises. It's a huge market, and they wrote nearly 12 billion pounds of this business last year alone, securing massive deals with household names like Ford and BP. I mean, they dominate with about a quarter of the entire UK market. Second, there's their investment arm, asset management. Now, this is a big deal. After a pretty tough period, they've finally reached an inflection point, bringing in 34 million pounds in new revenue. They're successfully shifting towards more profitable private market investments, and crucially, their average fee margin is actually going up. In an industry where fees are constantly getting squeezed, that is a very, very rare and positive sign. And the third engine is retail, which serves all of us as individuals. Their workplace retirement assets are just soaring, up 21%, and they have another 3.7 billion pounds worth of new schemes that are coming online right now. So this division is tapping directly into that massive, growing market of individual and workplace savings. Okay, so you've got three strong, growing businesses. But L&G's real competitive advantage, their secret sauce, is how these businesses all work together in a way they claim their rivals just can't copy. So check this out. It all starts with their asset management arm, which already manages money for these huge corporate pension schemes. Now, when those clients decide it's time to offload their pension risk, that pension risk transfer stuff we just talked about, a staggering 80% of them stick with L&G for the deal. And here's the kicker. When that happens, the fees L&G earns from managing that exact same money triple. It's a powerful, self-reinforcing loop that builds this deep competitive moat around their business. Now, let's be real. The report wasn't all positive headlines. L&G's management knows that to build trust, you have to face the tough questions head-on. So let's look at the big negative number that had some investors a little worried. This is it. I know what you're thinking. You see a number like negative 771 million pounds, and alarms start going off, right? What on earth is an investment variance, and is this a sign of some huge problem hiding under the surface? So let's break this down in plain English. An investment variance is really just the gap between what your models expect your investments to earn over the long term and what they actually earn in the short term. It's an accounting measure, not necessarily a direct loss of cash from the business. And this is where the new CFO really stepped up and provided some much-needed clarity. That huge negative number, it's made up of a few different things. A big chunk of it is just an accounting mismatch from model changes that, and this is ironic, will actually increase the profits they'll book in the future. Other parts are just short-term market noise and some genuine revaluations in challenged sectors like commercial real estate. The key takeaway? It's not one big hole in the boat. So management was very clear. They've addressed these old issues, they've taken the hits, and they are drawing a line in the sand. They're totally focused on the future now, and they've acknowledged there will be some ongoing costs for the next couple of years as they finish this big transformation. So we've seen the strategy, we've seen the numbers, both the good and the, let's say, complicated. But what does all of this actually mean for the people who own the company, the shareholders? This is the payoff. And again, the CEO is just direct and to the point. He made a promise to return more capital, and he's using these results to prove that he is absolutely keeping it. And this isn't a one-off thing either. It's a clear multi-year plan. They delivered £500 million buyback last year. They've just launched that massive £1.2 billion buyback for this year, and they're signaling there's more to come next year. This shows a really consistent and significant commitment to returning cash. And when you add it all up, L&G is on track to return more than £5 billion of capital to its shareholders over the 3-year period through 2027. That is a truly substantial figure. This really shows the strategic shift in how they're returning that cash. They've moved from a policy of just growing the dividend by 5% a year to a new, much more flexible approach. A smaller 2% dividend growth, but now supplemented with these huge value-driving share buybacks. For investors, this new combo is actually delivering more total value. So there you have it. Legal in General has simplified its business, it's clarified its story, and it is rewarding its investors with a ton of confidence. They've laid out a really clear plan built on their unique synergistic model. The big question now is, as they sail into a competitive market, will this new, focused course prove to be the winning strategy?